Welcome to Oxford Real Estate Insights and our podcast on real estate research and practice, the Property Pod. I'm the AI voice of your host, Martin Schmalz, and today we're tackling a puzzle. Why don't property owners make green investments even when they're economically beneficial? Our guests this time are Brian Lancaster from Columbia Business School and Cameron LaPoint from the Yale School of Management. Brian is a senior lecturer who teaches real estate finance at Columbia and Oxford and has researched commercial PACE financing and its potential application in the UK. Cameron is an assistant professor whose research examines residential PACE programs, focusing on how this financing mechanism addresses market failures in green building investment. In today's episode, we'll explore how PACE loans solve multiple market failures through creative structuring and learn about Cameron's research showing 20% home value increases and dramatic insurance premium reductions. Let's get started.
Welcome everyone. I'm very glad today to host Brian Lancaster and Cameron LaPoint. Cameron is an assistant professor of finance at the Yale School of Management and works on real estate, corporate finance, household finance, urban economics, and has most recently, well, not all that recently at this point, written a paper on residential property assessed clean energy loans, or PACE loans for short. We'll find out what that is. Brian Lancaster, in turn, is a senior lecturer in the discipline of finance at Columbia Business School, where he teaches all kinds of courses on real estate debt markets, real estate finance. That has a fantastic title of Dirt, Debt, and Derivatives. I'm very jealous I didn't come up with that. And most recently has also been teaching real estate at Oxford to fantastic success. Also, his teaching ratings I'm jealous of. So I'm glad that I get a part of him today. Brian has written a paper on CPACE financing and thought about the applicability of that concept also in the UK context. And if you're utterly confused about the connection, what CPACE even is, then you're in the right place, because that's what we're going to talk about right now. So, Brian, why don't you explain to us what CPACE even stands for, to introduce us to the concept?
Sure. Thanks so much, Martin. So as Martin had said, CPACE stands for the Commercial Property Assessed Clean Energy. And it's basically a financing technique that involves a public and a private partnership, whereby the building owner takes out a loan from a private lender, such as Counterpoint SRE. There are other lenders out there, and then uses the proceeds to finance improvements to the property of the building, such as making it more energy efficient, replacing windows, et cetera, et cetera. The trick is, though, that the repayment of the loan, unlike, say, a mortgage, is done through the local government authority and is repaid like a property tax. So this technique gets at two of the central problems that occur with other types of green financings. One is the mismatch, oftentimes, between the payback period for a green financing, which might be 20 years, 15 years or more, and the typical hold period for a lot of real estate property owners, which can be 10 years. But the problem with the traditional financing would be that with you take out, the building owner takes out, say, $10 million or pounds, whatever, to improve the building's windows, and it might have a 20-year period payback. However, the building owner might sell the property in 10 years, and so doesn't get to be able to reap that full payback period. What's interesting about the CPACE, as I mentioned, because the repayment is done through the local governmental authority, like a property tax, the repayment of the loan is part of the building, just like a property tax. It's not that of the owner. So that if, say, for example, the building owner takes out a $10 million loan with a 20-year payback, sells the building in 10 years, that obligation to repay the loan as a property, just as a property tax would be, would remain with the building, and so the new building owner would take on that 10-year repayment, the remaining 10 years repayment. The other central issue that CPACE deals with in the United States, and I'm not sure, Martin, you'd be better, you'd have more knowledge of this in the UK, but a lot of buildings in the US have leases that are what we call triple net. So triple net means that the tenant pays taxes, insurance, and maintenance typically, which include energy costs. So one of the other problems with the traditional financing for green energy improvements, the building owner again pays the $10 million to make the building energy efficient, improves the windows or whatever, improves insulation. And then the tenants reap the benefits because the tenants are obligated to pay their pro rata share of the energy costs. With the CPACE program, again, because the repayment of the loan is done through the local governmental authority, just as taxes, that repayment of the loan is passed through pro rata to the tenants. So the tenants benefit from lower energy costs, but at the same time are obligated to, or they're obligated in effect to pay their pro rata share of that loan back. Of course, it doesn't, yeah. So those are two of the central challenges that have occurred, Martin, with typical green financings, and CPACE to me gets right at the heart of those two issues.
That's cool. So let me just paraphrase this to make sure I understand this right. So the idea is there's an NPV positive investment, let's say, right? So this is not about fixing market failures due to carbon not being correctly priced or something like that. This is a market failure due to the owner of the property having to make an investment, but then not getting to reap the benefits, right? For one of two reasons at least. One being that if I sell the property after 10 years before all the benefits are reaped, then I'd have to convince a buyer, and there must be some sort of market failure there, some asymmetric information, friction, I don't know what, that makes that the energy efficiency isn't correctly reflected in the transaction price, or wouldn't be, So that's one problem. And the other one being, I as a landlord make the investment, but then the renter gets to pay cheaper energy bills. So again, there's an externality basically that discourages me from making this NPV positive investment that wouldn't only be good in terms of economic value created, but as a nice side effect also for the planet. Is that roughly the right way of thinking about it?
You got it. That's
Yeah, I
it.
mean, that sounds great, right? And then so now switching over to Cameron's research on the residential part of that, how is that similar or different in terms of the market failures or incentive problems that it solves, or the problems that it fixes?
So I think in terms of this positive externality that's not being internalized by the homeowners potentially, I think that there's some of that in the residential pays context. I think where things start to differ a little bit, keeping in mind that the financial infrastructure is largely the same for residential pays as it is for CPACE. I think where things start to differ is that typically the homeowners who are taking on these loans tend to be somewhat financially constrained. At least if you look in the data, they tend to have lower credit scores, lower income. They tend to be in neighborhoods that have high disaster risk relative to others that have enacted the PACE program. And so there's a sense in which our PACE is relaxing financial constraints of homeowners. So I think that that's one market failure. I think another one has to do with screening. So if you think about, a commercial PACE deal, you're going to have a bunch of different creditors and equity stakeholders that are contributing capital to that deal. And there's going to be a lot of paperwork, and they kind of, there's intercreditor agreements that will keep all of the stakeholders more or less on the same page about the performance of the property. I think if you're thinking about the problem of an underwriter, whether it's a traditional bank lender trying to give some sort of green home improvement loan to a homeowner where you say, okay, relative to traditional HELOC, you have to use the funds towards this project that I think is going to have this positive externality and be capitalized into the house prices. It's actually very hard to bond the homeowner to do that. And so I think there's a little bit on the RPACE side that I think is really more about the paper trail that solves this screening problem. So in other words, you worry that the homeowner is going to take the our PACE funds, and then instead of doing the thing that like home hardening measures where you install impact resistant windows and doors, where you instead would renovate your kitchen. And that may not have the same both positive externality, but it might also protect the collateral investment of the mortgage lender as well as the RPACE lender. So I think those are the two market failures, if you will, that are somewhat unique to RPACE, the financial constraints of the borrowers themselves, and also this kind of lack of screening problem that leads to unraveling the traditional private lending market for green home loans.
Yeah, very interesting. That's cool. And yeah, so what I wanted to understand is that in the paper, from the paper, I understand that these are climate proofing projects, and you mentioned that they're mostly taken up in more disaster-prone areas. So should I think of them as mostly adaptation efforts to climate-related risks, or also as ways to mitigate future um, climate change emissions and, just energy consumption, or is it both?
Yeah, so that's a great point. So the acronym PACE has clean energy in it, right? And so we may not think of these loans as being traditionally used for disaster proofing measures. And in fact, I think we need to take a step back to answer your question and think a little bit about the legal architecture that makes PACE possible, because the way it works in the US is that there's a Department of Energy mandate that enables PACE at the federal level. Then states can opt into whether they want to participate in the federal mandate, meaning they can pass legislation saying, okay, we're going to allow counties or local jurisdictions in our state to enable PACE. And so that's the architecture through which this becomes a lien on the local property taxes. That's the homeowner or whoever is the owner of the property would then pay back. But what the states also do in deciding whether to opt into the program is they can set various consumer protections. For instance, how much LTV can you have on this loan relative to the property's assessed value? But they also can set the range of projects that the PACE funds are applicable to. So there's some variation across states in terms of what you can actually do with the money that is a permissible use of PACE funds. In places like Florida and California, where you have a residential side to PACE, both states have enacted legislation that expands the set of traditional uses beyond clean energy investments, so beyond solar panels, energy efficient windows, to things like impact resistant windows and doors, or roofing measures, or
Flooding, right. California, even you can use it for earthquake retrofits, things like that. It's not just energy. Obviously, for flooding and things like that is very important too, but it's not just energy improvements, as Cameron is saying.
Interesting. And so it's very interesting,
Yeah.
in particular, the state level component to it, sitting in Europe in a completely fragmented regulatory landscape, of course. It's always good to see that other geographies have somewhat fragmented
Yes,
regulations as well.
And the other
And
thing, Martin, I think that's sort of interesting to point out here, which,
yeah.
As a banker and a financer and someone who's worked in capital markets, is that, about 2/3 of US states have adopted CPACE programs. And it's not just a blue state type, tree hugger thing, if you want to call it that, which to me speaks to the actual economics, the deal economics that work here. But you have states like Texas, and as Cameron said, in Florida, as well as California, Massachusetts, that all have programs in place for it. So it really, I think, and at least in the commercial side, I'm not familiar as much with the residential side, but I think that speaks to the value of this technique. And as you said, in Europe, you're going to have different situations in the UK or France or Italy or whatever, but the program can be pretty adaptable.
Yeah, so in terms of the legal framework that's necessary to implement it, is there a difference, Brian, between the residential and the CPACE context, or is this basically everything that Cameron said is applicable to the CPACE environment as well?
Yeah, well, I think I mean, again, I'm not by any means an expert on the residential side. I focus on the commercial side, and so Cameron can comment. But I think one of the big differences is that it's easier, my sense is that it's easier to trace the the improvements that the commercial property owner is making. In some ways, CPACE is a little bit like a construction loan. If you think about it, the building owner takes out the loan and then says, we're going to, I don't know, replace the windows or make them more energy efficient or do the insulation. So there's a monitoring process in the sense that, just as with a construction loan, as those elements are done on the building, like replace the window, you take out a $10 million CPACE loan, you get your first $1 million tranche, you start the project, okay, you've completed, I don't know, 10% of replacement of the windows, okay, now you get another tranche. So there's, I think, greater transparency where, again, I'm not an expert on the residential side, but as Cameron said, I don't know if the deal economics work such that a lender is going to go out there and, make sure that somebody is improving their fiberglass insulation and not, putting in new kitchen countertops, because I don't know what the levels of the loans are. If you're talking, I mean, CPACE loans now, they started at, say, a few $1 million on the commercial side. Now they can be 50 million, 75 million, 100 million, where that kind of monitoring makes sense, which is essential to the program so there's not fraud.
Yeah, and I think on the RPay side, the monitoring is potentially more difficult, and this varies a little bit state to state. But if I take Florida, for instance, I think Florida has found a little bit of a way around some of these agency problems to make it incentive compatible for the homeowner to not just take part of the proceeds and run away with them, or to use it towards this kind of cosmetic non-green retrofit, if you will. And what I mean by that is that basically, if you were to try it, if you think about a homeowner who wanted to use the funds for something that wasn't allowed, they would face a pretty high hurdle in terms of they'd need to get a bunch of people who are involved in the origination of the loan to collude with them on this fraud, if you want to call it that. In particular, what happens for the homeowner is when they get a PACE loan, so they're screened, they're approved, the lien gets recorded, they get essentially a disclosure form that tells them the terms and conditions of the loan, the payback period, the interest rate, and all that. The contractor that is working with them needs to be a PACE approved contractor. So, and there's been a lot of scrutiny on the contractors given some consumer protection concerns with PACE in recent years. But essentially, the contractors have to be approved by the state under that state's PACE regulation. And then the contractor, when they start working on the project with a particular PACE use that is tied to this loan, they then have to issue something called a notice of commencement on the project, which has an expiration date. So if that project is not completed within the expiration date, typically a year, the idea is that the funds have to be returned in some way. So basically, you would have to get the contractor on board with writing to the government saying that they're doing one project, but you're actually doing something else with the funds. And the assessor's office needs to be aware of all of these changes as well.
Yeah, so I mean, so that just illustrates how intricate it really is to implement this and to implement it well, to get around all kinds of frictions, agency frictions, asymmetric information problems, as we now discussed. And I guess one objective of Brian's CPACE white paper from the Future of Real Estate initiative was to think about what would be needed to transport this to the UK specifically. But I guess a more general question is, what would one have to do to transport these techniques to other countries outside the US if one wants to be more ambitious and just rolling it out within the US, no? Because also the market failures that this type of financing addresses, they are of course universal, no? So they seem to exist elsewhere on the planet as well. So there's a temptation to that. Now, before we get to the international rollout and what is needed there, I just realized we didn't even get to the empirical results of Cameron's paper. So Cameron, if you can just quickly say what you do and what you find there in your empirical analysis of your PACE paper.
Yeah, certainly. So, I mean, again, we're focusing on our pace, although we have some properties that in principle could be small commercial. So what we do is because of this sort of fragmented infrastructure that PACE relies on in the US, we had to build this database going county by county. So we did this for the state of Florida, and we contacted all the assessors in the state of Florida, and we said, okay, we know that you've recorded some liens for PACE in your jurisdiction. Can you give us the set of parcel identifiers for all the properties that are implicated here? Because again, as Brian mentioned at the beginning, just like with CPACE, the loan or the lien on the property is specific to the property and not the owner of the asset, right? So in that sense, if you were to sell and you had a PACE loan that was still in its payback period, then the new owner would need to either assume the obligation by owning the property, or it would need to be paid back through the proceeds from the sale. So we go county by county. We build out the set of properties that have received this financing. And then what we find is essentially that what people use the funds for in a place like Florida is not really on the clean energy side, at least as far as we can tell. So if you look at the permitted projects that the contractors file, they're about 60% towards things like roofing and impact-resistant windows and doors. 20% seem to be in this kind of hodgepodge other category, which is there's a small set of PACE enumerated uses that we may not think of. So for instance, septic to sewer, water efficiency projects, that would be in this sort of other category. And then traditional things we think about as being energy efficient upgrades like modern HVAC, or solar, that would be the remaining 20%. So just in terms of what people use the funds for in Florida, it's much more on the disaster proofing side. And I think importantly, if you're thinking about like how does this pass through to property owners and the other stakeholders, such as the traditional mortgage lenders, we find that there's broadly a lot of benefits to the program when the funds are used in this way. So we showed that homeowners insurance premia go down significantly if they engage in one of these, particularly the window and door replacement upgrades. The reason being that damages in the event that there is a storm are going to be lowered, right? And so the amount of claims that the insurance provider has to pay out goes down. This prevents some of the unraveling of the insurance market we've seen, and this gets capitalized into higher house prices. So that's largely what we find
Can
in
you
a
say something
nutshell.
quantitative about this? So, how much higher home prices, and does that somehow pan out with the payback period and reasonable discount rates on the reduction in insurance premiums and other savings?
Yeah, absolutely. So we find, and this varies a little bit depending on how you slice the data, but what we do is we look at the set of PACE homeowners who essentially get the loan, they do one of these disaster proofing upgrades, and they sell the home, typically within 3 to 4 years, right? So
Yeah, to Brian's point that this is pretty early after the investment, so yeah, it's easy to see that.
Yeah, and we don't think that these are flippers, to be clear. They just seem to be people who are, moving up the housing ladder because again, for our pace, this is really a program targeted towards people who might face difficulty getting a traditional home equity line of credit to do this work. So the house price, if you do one of these windows or door replacement projects, will go up by 20 to 25%. So it's quite substantial. And what we do, we were surprised by this initially. So we then thought, I think as Martin pointed out, is can you rationalize this with reasonable discount rates? And the answer is yes. So then what we do is we say, okay, well, on average, a county that gets the PACE program enabled, so the assessor's office says we're going to record the liens. There's a counterpoint would be one example. They decide to enter into an agreement with that local government and provide the loans or underwrite the loans. At the county level, home insurance premium go down by around 2%. Now that may sound small. However, if you think about the take-up rate for PACE, it's still quite small. So the market has a lot of room to grow. So the take-up rate for PACE is around 2% in most Florida counties. So if you scale that up, we're talking about essentially a halving of people's homeowners insurance premium annually.
Oh, wow.
So then it becomes kind of clear what's going on. If you engage in one of these projects, your house price goes up by 20%, but you can potentially lower your homeowner's insurance costs by half in disaster-prone areas. And so then you don't need a very high discount rate at all. And so in fact, we find discount rates of 2 to 3% can rationalize this increase in home value.
Yeah.
And then, so combining this estimate of the 2-3% discount rate with the interest rate on the loans, I guess that's also consistent with your interpretation of these being financial constraints at work, no? Is that right?
That's right. That's right. And we do a lot of work in the paper to try and get a baseline sense of, how financially constrained could these homeowners be. And if you compare them to traditional home equity line of credit borrowers, they are largely lower income. They will be in they will have houses that seem to be in the money option in terms of the retrofitting. They'll be sort of older properties, lower tax assessed values. We also look at, the number of credit cards that seem to be associated with that address. So credit access generally seems to be lower. Perhaps this is one nuance I should point out for RPACE versus CPACE. At least I'm not aware that CPACE has any such provisions along these lines, but with RPACE, I think one of the big financial innovations that gets at this financial constraint market failure is that in most contexts, the underwriters are not allowed to use FICO scores as a method for screening. So they can do a credit inquiry to screen the borrowers, but they're only doing that to check whether there's a pattern of delinquency in the last few years. They can't actually use the FICO score as a direct criterion to set the interest rates or to decide yes or no whether that borrower is eligible.
Yeah.
Yeah.
And Brian, I just cut you there. Go ahead. Yeah.
Oh, no, I was just going to say, since Cameron is addressing the issue of, credit, on the commercial side, because CPACE runs with the finance, is the financing that runs with the land or the property and is not a direct obligation of the owner, who in effect is really sponsoring the CPACE program. As such, like a special assessment, they're viewed as off balance sheet for the property, for the commercial property owner. And so they don't have any impact on their credit ratings. And did you want to talk a little bit about the benefits? I know Cameron was addressing the benefits to the residential homeowner. There
Oh, yeah,
are,
yeah, absolutely. Go. Yeah, please,
yeah,
Brian.
on the commercial. So the credit one, there's no impact on their credit rating, which is great. Also, as I met, one of the things it's sort of a challenge and an opportunity of the CPACE program is that because the CPACE loans are repaid as almost as if taxes would be paid, they rank senior to other obligations in the in the case of a foreclosure or default. And as such, the financing costs are lower than it would be, say, than doing a first mortgage, taking out a mortgage or our mezzanine loan, which would be subordinate. So the financing costs are typically cheaper, again, because they rank so senior in the capital structure. And then the other, it's sort of interesting on the CPACE side, is the concept of recapture, where CPACE loans on the commercial side can be used to finance or recapture costs that may have been already refinanced as a look back period in many cases. So if the building owner had already done improvements, then a loan could be, in the past, for energy efficient improvements, the loan could be taken out to recapture some of that. So those I think are very attractive from a commercial property owner perspective. Plus, of course, the cost savings and improvement in the building value, hopefully, that the program produces.
Yeah, so thank you very much for summarizing that. Now, what our listeners might not yet know is Brian does many things in life, including leading study tours all over the planet, literally all over the planet. I don't think you've led a study tour, a real estate focused trip to Antarctica, but other than that, I think pretty much all the continents that I can think of. And of course, has had an illustrious career at various institutions, including in England. Is that right? So you worked at the Bank of England at some point?
Yes,
Yeah.
my first professional job was at the Federal Reserve Bank in New York, and part of it I was actually looking at risk-based capital measures for all those newfangled things called securitizations.
Huh.
And I did the first secondment between the Fed and the Bank of England to try to communicate, act as a liaison between the two institutions, and then ultimately with the Ministry of Finance in Japan. Yeah, so it was a great experience at the Bank of England. I
Yeah,
also got to experience I was joking with Martin, the beauty of places like the Bank of England, but how chilly they could be. Certainly in need of a CPACE loan, in my opinion.
That's right. So, and Cameron, you have a paper on Bangladesh as well. So both of you have quite international perspectives. And so Brian's paper on CPACE is a white paper, thinks about whether that would be a good idea to roll out in the UK as well, right? So I just want to go back to this question we started addressing previously about what would need to be done to roll this out in other jurisdictions, I guess, as well. So I don't know who wants to start, but maybe let's start with Brian, given that you've actually written a paper about it.
Yeah. Again, the major thing would be to have enabling legislation, which I'm not an expert on what's happening in UK, but in the United States, my understanding is this started under the Obama administration, where there was an effort made to try to get a program like this in place. So you would need legislation at, I assume, the British parliamentary level and at the EU level. All the intricacies. I'm not a lawyer. I'm not, I don't want to opine on that. Maybe Cameron, you could have more specifics, but I think something like this podcast and the paper and Cameron's paper, hopefully that, as politicians see the benefits of this program and realize, again, it's not a conservative, it's not a liberal issue. It's just a really cool program that gets around some of the problems and typical financings for improvements, energy improvements to, deal with this head on. They will be more receptive to getting legislation like this. I don't know, Cameron, do you know, again, I'm not an expert on the legal issues, Cameron. I know how the program works, but I don't know all of the legalities that they had to go through at the national level in the US to get this done.
Yeah, I mean, so I can talk a little bit about some of the legal challenges that PACE has faced in the US, and then I have some thoughts on maybe a different set of legal challenges that you might face in porting some of the financial infrastructure of PACE or something like property linked finance to the UK. I think in the US there have been two sets of concerns because it's essentially this Russian nesting doll. You start at the federal level, DOE mandates down to state level legislation, and then the counties themselves decide whether they want to enable PACE. You have two sorts of challenges. So one is on the consumer protection side for our PACE. Essentially, you want to make sure that people who are taking out these loans know what they're getting into, especially given that you're dealing with a financially constrained borrower population generally. And so this has led to some regulation from the Consumer Financial Protection Bureau, finally including PACE in the Truth in Lending Act at the end of last year under the Biden administration. And there have also been a number of lawsuits, alleging that contractors have an incentive to really sell PACE to their clients because they're trying to drum up more business, and this allows them to essentially do the work with little money down initially. And so I think that has resulted in this paper trail really being strengthened, as the disclosure forms that the bar receives have been more harmonized. And so I think we're kind of moving into an era where PACE doesn't have to deal with as many consumer protection concerns. I think now the bigger concern for PACE is that it's actually quite labor intensive and it requires a lot of administrative capacity for local governments because of this fragmentation. So I think that may not pivot as well to the UK, depending on how the loan is secured or guaranteed. In the sense that, if you have this lien that follows the property, in the UK, my understanding is that there's no traditional property tax, right? So there's a question of how you would actually do the repayment process, who would actually be the person collecting the payments. I mean, my understanding is that there is some sort of occupancy tax. So in theory, you could try to one-for-one map what's going on in the US to the UK context. The other issue I see with thinking about how this might translate to the UK is I understand that if the loan follows the property, well, what are the rights of the owners of the property where you have a leasehold versus a freehold situation where, in the US, basically, the owner of the building is usually the owner of the land as well. In the UK, those things can be separated, and that's actually quite common. And so then there's a question of, I'm not a barrister in the UK, but what would you do if, you have your leaseholder wants to do PACE, and you as the freeholder don't like it, for whatever reason, like you don't approve of like the retrofit that they're doing, or um, you worry that like they're going to default on their agreement, and then you're essentially stuck um, uh, repaying this loan. So like there's all these kind of questions of who holds the bag at the end of the day in the event of default.
Cameron, I had a question to that point. As you said, as you mentioned in the UK, where you have so many land leases. Again, I'm not a lawyer, but typically the property taxes in the US, and this becomes a legal issue. A CPACE loan would rank senior to other issues, like the government comes first in the case of a bankruptcy, and then the land lease, and then the mortgage on the building. I don't know how that would work in the UK, but that, could be an issue too if the owner of the land, if it's a lease on land, that they would be subordinated. Because that has been an issue in the US with some banks. If you take out CPACE on a commercial building, then the first mortgage gets subordinated to it. We can talk about it's actually not as big of an issue as some people think, but that uh, uh, has been an issue.
Right. I guess putting another way, would there be a jumping the capital stack sort of
Mhm.
rule here? I think that's something that would need to be worked out, right? Because a ground lease typically is super senior, right, to other
Mhm.
claims.
Right.
Um,
But
and
not
so
to
the
taxes, is it?
not to taxes, at least in
Right.
the US, in the
Right.
but is this going to be secured through the tax system in the UK, right? And so
Right.
if yeah, so there's a lot of open questions about how you actually order the capital stack with regards to property link
I
financing.
hope a few lawyers are listening. We have some of them among our partners at the Future
Yes.
Real Estate Initiative. So you
Yeah.
see, there's lots of
Well,
intricate questions there. Brian,
yes.
yeah?
And one thing I think that is interesting though, Cameron and Martin, is that while in the US, some of the, commercial banks have initially when they hear about this, they're like, I don't like this. I don't want, an additional loan or a loan being taken on the building is going to subordinate my first mortgage. Once they understand though that the way it works, it's not like a mezz loan or something like that where if the building is, if the owner's in default or is foreclosed upon, the entire loan is accelerated as part of the foreclosure process. In other words, if say I take out, $1 million CPACE loan and the interest on it is 5% a year, so that's $50,000. If the building owner defaults on their mortgages, only the $50,000 it's like property taxes. Only the $15,000 per year is senior or primes the first mortgage. It's not the entire $1 million mortgage. And I think that's an important point that a
Yeah, that
lot of
is.
lenders don't understand. And that sort of makes it more palatable, at least in the US, to a lot of them.
Yeah, so at the end of these podcasts, I always like to try and speculate a bit. And of course, as in academia, we say there's no discussion is complete without a reference to the discussant's own work. No? So one of the things that we've been working on, Chloe Garnash, the associate scholar at the Future of Real Estate Initiative, and I, is on how house prices capitalize increases in electricity costs. Right. So this paper, it's called Sticky Asset Prices. Um, leverages a shock to electricity prices in some parts of Norway that came due to both the Russian invasion of Ukraine and the energy crisis that followed, but also new grid connections to Norway, right? So suddenly you have energy prices shoot up by a factor of literally 10. And when your electricity bill increases by a factor of 10, that you don't have to do a lot of math to figure out that this quite quickly can reasonably impact the value of a house. And one of the things we do observe is that people do start making energy improvements to their houses as a result of that, in addition to, us observing an impact on the house prices. Anyways, that's a long introduction to just saying, if energy prices increase, then of course improvements in energy efficiency become more valuable or can be anyways. And we spend much of the podcast talking about the intersection here between regulation and sustainability in real estate, which are two of the focus points of the Future Real Estate Initiative. But the third one is AI. So I'm starting to come to the point. The point being, there's these things called data centers. I hear they consume a lot of electricity, and if I read the news, I read that electricity prices in the neighborhoods for the residential properties go up. No, so that is a gigantic negative externality. It strikes me from the data centers to the homeowners in these neighborhoods. No, so I guess the first question is whether that you would expect that to accelerate the demand for energy improvements in these houses that could be financed with PACE loans. But also, I guess more broadly, how do we think about these pecuniary externalities that come from data centers through an increase in electricity and energy prices? I don't know who wants to go first here. Brian says
Yeah, I mean, I'm not a day. Actually, one of my colleagues
Yeah.
at Columbia has done a great paper on AI and its impact on the on energy and all of that. But yeah, I mean, it's apparent. I mean, some of the data is just sort of mind-boggling, and that we're creating, every couple of years, AI is consuming as much energy as the state of New Jersey or something like that. I mean, there's sort of these phenomenal numbers, and there's actually, as you probably read in the papers, there's a lot of resistance now in communities to allowing in data centers because they are increasing energy costs. So I would think that that is just baked in the cake in terms, we just don't have the energy infrastructure. It can't be, they're, as much as they're trying to build it out, it's not being built out fast enough. It's consuming it faster. I mean, the other thing I didn't mention, Martin, which is interesting, and I'll let Cameron speak to the AI, but it's an important point. A lot of cities like New York, Amsterdam, and I believe London are imposing scheduled penalties on inefficient buildings. So you walk around New York City, my building has a D and it was built, 20 years ago. There's a whole series of penalties coming down on commercial property owners if they don't get higher ratings. So there's that factor too out there. But Cameron, why don't you address? I just wanted to make sure that was an important point. But Cameron, if you want to talk about the AI and energy impact, please do.
Yeah, I mean, so my understanding is that while the data centers are starting to get a little bit more optimized in terms of their energy output, we also have just ever increasing demand from, as the user base for, AI based tools increases through the population. But I think this is also something where PACE could really have a lot of room to grow. So the data center capex is really concentrated in the U.S. right now in Virginia and a few places out west. But our PACE is really only available in California and Florida currently. And so in that sense, the program has a lot of room to grow in the areas that are probably experiencing the largest increase in homeowners' utility bills. What is that going to require? I think it's going to require some initiatives at the state level as well as some work to be done to, largely outreach to the local government authorities that are going to need to have the administrative capacity to actually record the loans on their books and issue a special assessment for the tax bill. So yeah, I mean, I think that I can tell you I have some follow-up work I'll just kind of tease here that might speak a little bit more directly to this. So I mentioned Florida, the loan proceeds for PACE are typically used towards disaster proofing measures. In California, well, it's true you can use the funds for earthquake proofing, but also as of 2019, although the take-up has been fairly limited, you can also use it for wildfire proofing in California. So you could have kind of fire resistant siding on your house. That would be one potential use of PACE funds. Traditionally, it's been almost all solar and HVAC projects. And so California has really taken the clean energy and PACE seriously. I think, so there's a question of like, will there be, if the take up was great enough using our PACE or some other financing mechanism, um, to what extent can you sell back the energy to the grid seems to matter a lot. So California in 2017, I believe, stopped allowing homeowners to sell back their energy to the grid from their home solar panels, and so this led to a little bit of delinquency in some of these securitized pools of solar-backed ABS. And so this is a clear, issue in which, if you kind of overshoot or over forecast demand for energy, there can be some of the negative consequences. So, I don't want to sit here and say that everyone should be getting a PACE loan to do solar on their house, because we don't know where data centers are going to be located. And also, if the energy that they're drawing on, it may not be co-located with the center itself. And so I think this is a bit of a moving target, and it's difficult to say.
Well, that's fascinating. I'm learning so much here. Um, I wish I could take classes with you all day long. Um, and so I guess we didn't have time to talk about the securitization aspect of it. We just mentioned it. Brian, of course, has spent a significant part of his career in that ecosystem. So, Brian, if you wanted to add something to that, then go ahead. But otherwise, people can find you online pretty easily as well if people need expert advice on this issue. But Brian, you look like you might want to chime in.
Sure. Can you hear me, Martin?
Yes, I can, but apparently you can't. No? Yes?
Yeah, no, now I can. It just for a moment it stopped. But yeah, as I mentioned before, there actually have been a number of securitizations of CPACE loans, which is fantastic because that means more money for these programs. And, the rating agencies like them a lot. Because again, this whole issue that the CPACE loan ranks most senior, at least in the United States, like taxes in terms of repayment, in terms of bankruptcy. So, and the issuers love them because, again, the whole key is where you are in the capital structure and the amount of risk in a commercial real estate building determines how many AAAs you can squeeze out of the bonds that are backed by the loans. And as I mentioned, you can get 90% of all the collateral into a AAA, which is fantastic in terms of deal economics. And then also investors like them. Once you get the bonds in the form of the bonds, there's a lot of investors out there that like and want to do green investment. I know it's right now not necessarily as fashionable in the United States. However, we have firms like Natixis, things like that, who are very interested in it. A lot of European banks and a lot of American banks too, and investors who will buy these bonds. So number one, they get a really nice, high quality, investment, and on top of it, they can feel that they're doing good. So I could see the securitization market has already taken off in this program, and I would expect that to continue, and you'll see more and more deals. Particularly, Cameron touches on this with the residential side. The first PACE mortgages were a few $1 million. Now they're 50 million, 75 million. They're really nice size chunks of cash that make sense economically to securitize, get rated, things like that. So I can only see the market growing further.
Well, that was fascinating. Thank you so much for your expert insights into that field. I always think that if I had to pay for the people's time that I'm talking to, I'd be very poor. So I'm very grateful that you spent the time on this and helped us learn about this fascinating form of financing. And I hope I'll get a chance to talk to you soon. Thanks for coming on.
Great.
Thanks
Thank you.
for having us. Yeah.
Yep. Thanks, Martin. Thank you, Cameron.
Thanks, Brian.
That was Brian Lancaster from Columbia Business School and Cameron LaPoint from Yale School of Management, sharing insights from commercial and residential PACE financing. PACE's core innovation is simple but powerful. Make loan payments, run with the property like property taxes, so the obligation follows the property instead of the owner. This structure solves fundamental real estate problems, hold period mismatches, and landlord-tenant cost splits. Despite only 2% adoption in Florida, Cameron's research found remarkable impact, 20 to 25% home value increases. Perhaps most surprising, over half of these PACE loans in Florida actually fund disaster-proofing rather than energy improvements, resulting in 50% insurance premium reductions. Thanks for joining us on the Property Pod from Oxford Real Estate Insights. Don't forget to subscribe for more research insights on the future of real estate. I'm the AI voice of Martin Schmalz, and we'll see you next time.